I will say yesterday I talked to you about what is the return on equity. What is the money that the equity holders are getting out here. In this particular case also, please note there is a small difference out here. In the return on investment also, when I say E out here, equity, equity means and includes share capital plus reserves, total reserves are, make it, no, do not take only retained earnings, total reserves and surplus. So, what we call it as basically net worth out there, net worth in the process. Whether it is return on investment or return on equity, when I say equity, all the money belonging to the equity holders out there. Anshuman, need some water? Sure. I think no, it's okay, no problem. Change of weather. Bangalore is equally hot. Well, last week I was there. I think it was equally hot or even worse. Anyway, now let's come back. I talked about, yesterday we talked about equity holders also. We started with equity holders. When I look at equity holders, we look at couple of aspects out here. I said first, the equity holder will also be interested in debt equity ratio. Why? Because if the debt component is very, very high, the equity holder will be worried. Why? Because lot of risk he is assuming. Because why, what happens, when imagine you are going to, the company has advertised what is called as, you say I am garnering I am issuing 10,000 shares to the public of $110 each. You want to invest, you will also look at what is the debt equity ratio already. There is 80% debt, 20% equity in the company. Damn it, that fellows who are debt providers will continuously keep getting the interest and entire risk will be borne by the equity holder. So, you will also be worried about debt equity ratio as the equity holder also. Am I with you on that? So, that part of it is over. Then the second aspect, what you will be worried will be return on equity. Yes? Which one? Both will be worried. That is why we talk about optimal capital structure, which you will learn in Finance 1 in Q3. Optimum combination of debt and equity. And let us look at return on equity. When I look at the second aspect, what they will be return is return on equity. Return on equity is whatever is the PAT basically by net worth out here. Second aspect, what they will be interested in. I will put up the slide on Moodle by tomorrow, so you can look at it. The third aspect, as an equity holder, what are you worried about? You are worried about what you call it as EPS. We are looking at earnings per share. When we look at earnings per share, what am I looking at? When I say what is the earnings per share, let us say, for example, the company has a PAT in this case of $60,000. The number of shares in the company has is about 100 shares at what is called as $10 each. So, what do? What is the earning per share? That is nothing but 60,000 shares, 60,000 is the PAT by how many number of shares I have? I have 100 shares. Per share, what is the earning? Per investment, what is the kind of return that what we are getting? That is what we call it as the earnings per share. Now, so far I have not touched the market part of it. The next aspect out here, you would invariably look at this stage basically when we talk about is the next is basically the price to earning multiple. The price to earning multiple. When I talked about the price to earning multiple out there, we are looking at, now we bring in what is called as the market price out there. Whatever is the market price of the share, that I sort of divide by basically by my earnings per share will give me what is the price earning multiple. Now, what is this price earning multiple? Let me talk about it. What is this price earning multiple? Now, this itself will be sufficient for me to explain out there. Now, price earning multiple is nothing but your way of predicting the share price based on the profit or the earnings the company is making per share. Repeat, your way of predicting what is the value of the share, I will not even use the word market price here, what is the value of the share based on the earnings each share is getting. I repeat, your way of predicting what is the value of the share based on the earnings each share is getting. Now, please focus here on this board out here. What am I doing? There is a earnings per share. Now, if I have some multiple out here, if I am basically sort of looking at multiplying my EPS and my price earning, whatever is the multiple out there, I am getting some kind of a value at the market price. In short, let us take Wipro is a closely held company. Infosys, what is called as very diluted shares and widely held company. Now, I need to know, forget about the market price, I need to know what will be the value of Wipro equity shares out there. I am just taking Monday company. You look at, what are you looking at? I look at the company which is basically comparable in terms of size, operations, etc. to Wipro. So, I will say Infosys could be possibly, may not be now, maybe for 10 years back, they would be almost near and comparable to Wipro. So, what do? I need to have the value prediction of Wipro. So, what do? I look at, I can find out what is the EPS or latest earnings per share from the annual report out there of Wipro. But I need to know what is the value. Market price is different. Market price may not predict, may not be a clear real picture of the value of the company. It might be more or less out there. So, what do? Now, I will keep looking at, I will say comparable in this particular case is what is called as your Infosys. I know the market price of Infosys is reflecting the value of Infosys. So, I will find out what is the price earning multiple of Infosys. Simple, I will know what is the market price of Infosys, I will know what is the EPS earnings per share of Infosys, I know what is the multiple, what is the kind of numbers I have. That is, market price is equal to how many times the earnings per share. Very simple, market price is equal to how many times the earnings per share. I have that rough number. Now, I will take that rough number because I know that is the intrinsic value of the company. I will just take that number and then apply it to Wipro. If I apply it to Wipro, what happens? I know the Wipro's EPS, that is earnings per share. I will multiply with the same multiple what is there for Infosys. I will get some rough value of what is called a ballpark figure value of what is called as Wipro out there. Am I with you on this? That is what we call it as earnings multiple. Earnings multiple, when we say price earning multiple. What is the price? Price is the value of the stock. Earning is what is called as this, that multiple of that. What is the number? What you will basically look at. Now, can that change? Yes, it can change. Will it change every minute? It will change every microsecond, sir, because share prices keep changing every microsecond. But what you are looking is a ballpark figure out there. Am I with you on this?
So, EPS will be different from the face value of the share?
EPS will always be different from the face value of the share. It can be lower or higher. EPS is dependent on what? On the profit that you have made from the company. Face value of the share is what is denominated it. Face value, nobody worries about it. Only yesterday I worried about it in the quiz. Otherwise, nobody worries about the face value. Right? That is all. You are looking at buying at the market value. If somebody is prepared to give it at a discount, that's your luck. Face value, forget about it. Okay, in Kingfisher Airlines, face value is 10 rupees. What is it worth now? Less than a rupee. Nobody is buying it. So, face value is nothing. Only face value is required when they denominate it. Afterwards, nobody bothers about it. Only people like me, when they teach, we bother about it. That's all. Fine. Now we move on. Now I looked at the equity holder. Equity holder, when I looked at, let me list down out here what all so far what all I have done. For the debt holder, let me list down. I did debt by equity. I did interest coverage. Yesterday, I did return on investment. That's all right, only 3. Now I talk about the next page. I will go ahead and I will talk about what is called as the equity. When I talk about equity holder, I will talk about return on equity. I will talk about what you call it as EPS, the earnings per share. I will talk about the price to earning multiple. Yes, please.
This P multiple that market price, who determines?
Market.
Market.
Market, whatever. At this minute it will be different. By the time we finish the class, it can be different.
So if it is an unlisted company,
If it is an unlisted company, that is where you use the proxy. Beautiful, sir. Now, if it is an unlisted company, I do not know the PE. That is where the example what I said. Imagine I am looking at an unlisted company. I will look at a comparable listed company. I will take that PE multiple and then use this earnings and multiply that and get the approximate value. Reverse, that is all. Approximate. Approximate. That is where I use I always qualify my statement, sir. I always use it approximate. I always said ballpark figure. Well, when we talk about, I teach valuation, corporate valuation, right? I mean, that is what I am doing for your senior. When we teach valuation, when we arrive at a value, we can never arrive at a single figure. If you arrive at a single figure and say this is what is the value, nobody will believe. It is always a range. It is around that. That is all. That is that around is how big a circle you draw, that is up to you. That is not up to you when I say, that is based on assumption what you have made. If the assumption what I made is exactly comparable, then the circle is very small. Is somewhat comparable, then the circle can be bigger. That is all. Now, I am going back to debt part of it out here. Sorry, I am going back to debt part of it out here. One more aspect out here. Now, why do you borrow? Why do you borrow from the company? Why do you borrow from a bank or from a financial institution or foreign financial institution? Capital. What do you do with the capital? Invest. Liquidity is not, you borrow for basically when you borrow, you borrow for making a long term investment. That is what is called as debt. Long term investment is you borrow for making an investment in a fixed asset out there. Supposing you also look at, imagine a company, it keeps on borrowing, fixed asset is not increasing, that is the top portion of the balance sheet in the asset side, whereas the second portion of the balance sheet is increasing. That means what is happening? There is a misuse of money, that is the purpose for which you are borrowing, you are not basically utilizing out there. So, as a debt provider, I will also be interested in knowing whether my money is being invested in asset that is going to create value. Then what happens? The security for me is higher, otherwise the security for me is lower in the process. So, what happens? What will I look at? I will look at the kind of debt portion part of it to what we call it as the fixed assets part of it also. What portion of the fixed asset is financed by debt? Supposing fixed asset is say 1 million, my debt is 500,000. That means I know at least 50% of the asset is invested based on my what is called as the borrowing what I have made. So, I will be interested in that portion also. Yes, sir. Huh? Sir, normally working capital are always short term loans, sir. We will not take it as a long term debt. They are all what is called a short term debt. I have not come to working capital, I will come to working capital in about 10 minutes from now. So, that is what now we have talked about two aspects, that is we talked about the debt holder, we talked about what is called as a equity holder also out here. Now, I am looking at there are a couple of aspects, other aspects what we talked about yesterday also. We talked about liquidity. Liquidity means nothing but, if I have to put it in a simple sentence, ease of conversion to cash. Ease of conversion to cash out there. That is what we call it as liquidity. Ease of conversion to cash out there. When I talked about liquidity, I look at what are the assets and liability, what are the assets that has a ease of conversion. We will say all my current assets have a ease of conversion to cash out there. Why do I need liquidity? I need to pay off all my current liabilities also. So, I am looking at ease of conversion out there. I have to pay off all my current liabilities. So, I look at ease of conversion. Now, further part of it, what do you say? Among the current assets, there can be some assets which are sticky in the sense which are what you call it as raw materials and finished goods, that can be little more sticky. So what do? You look at basically quick assets and basically my current liabilities out there. That will give me the liquidity position. In short, whether all my current liabilities can be met by my current assets out there, that is what I am looking at in this particular case. Yes, Malika. Yesterday I mentioned briefly, anyway do not worry, I will do it again, I will sort of revisit now. When I talk about yesterday, anyway I might not have explained it properly yesterday. So when we talk about current assets, what are current assets? Inventory is a part of current asset. It can be finished goods, raw material, work in process. It could be what you call it as all your debtors. It could be basically all the cash and liquid what you call marketable securities you could have. Now if I look at this, cash and marketable securities already equal to cash, do not worry about it. Debtors, I can just go to the bank and discount it, I can discount it and then that is easily converted to cash, fine. When I look at raw material and work in process inventory, imagine in this particular case a Maruti Udyog, you have a semi finished car, that is a car with a body which has no engine, you will never be able to sell it, right. The ease of conversion for it is slightly more stickier compared to the other two. So we are looking at assets which are quickly convertible. So among the current assets minus the inventory whatever, that is what is basically the quick assets out there. With you on this? So far so good. Now second, basically we looked at this particular aspect also. Now let us take an example. He has a question, let me sort of address this, the question with through this particular current asset, current liability. Now we always use the word what is called as working capital, working capital, working capital. What is this working capital? Working capital is nothing but the money that is required for the day to day operations, not for long term investment, for day to day operations. So what happens? You will always look at the short term loans for meeting the day to day operations of the company. Short term loan, basically looking at short term loans for day to day operations of the company. When I am looking at short term loan, I need to know how much of short term loan do I need? How much of short term loan do I basically need? Let us take one very simple example, do not even write. Imagine I am purchasing raw material on the 1st of April 2019 on a 30-day credit. I have purchased that means raw material has landed in my factory on 1st of April, 30-day credit. I use it for whatever manufacturing a particular product. On the 10th of April, I am selling that good to somebody else again on a 30-day credit. I do not need cash for doing this operation. I have bought on credit, I have sold on credit. When do I need cash? I need cash only on 30th of April when I have to pay the fellow, and for how many days I need cash? I need cash only for 10 days because on the 10th day from what is on the May 10th, I am getting money from on the sales what I have made. Am I with you or not? So what is my requirement? My requirement is money which is only for a very short term out there, that is for a 10 days. That is what we call it as a working capital requirement. In a company, it is not one purchase and one sale that is happening. There are continuously purchases happening, there are continuously sales happening every day. So what happens? The difference basically, now I would have sort of bought on 1st, I would have sold on 10th, I would have bought on 2nd, I would have sold on 11th, I would have bought on 3rd, I would have sold on 14th and so on and so forth, and your what is called as payables keep accumulating, receivables keep accumulating. And every day you are receiving money on some sale, you have to pay money on some purchases what you have to make. Now what we look at, most of your current what do you call it as payment, most of your credit, what you call it as a sale, credit sale is financed by whom? Financed by the fellows who have provided credit to you when they have sold their raw material. Most of your credit sale is financed by the fellows who have provided the credit to you when you have sort of purchased the raw material. So what are you looking at? You are looking at financing only for a short period of time. So what we normally look at when we say is current when we look at working capital is whatever is the current asset minus whatever is my current liability is what we call it as the net working capital requirement. Because most of my current assets are basically what is called as my financing, basically looking at the difference is what it is. In the sense, let us look at my receivables, my sales is 10 lakhs in the month, and my what is called as my sales is 10 lakhs out there, and my purchases, imagine, let us not even, let us look at a trading firm, let us sort of shrink it further. I am a trader, I have bought raw material this morning for 7 lakhs, I have sold the good for 8 lakhs today, bought for 7 lakhs, sold for 8 lakhs today, and both are on 30-day credit, let me say, or for example, or I have both on 30-day credit. Now, when I am looking at on a 30-day credit, maybe today is what is called 3rd of March out there, that means I will get money only on 3rd of April out there. Now, 3rd of April I will get 8 lakhs, I can easily pay 7 lakhs, perfectly all right, there is no problem. But on 30th of March I have employed one boy to sort of help me in the trading, I have to pay that fellow salaries. When I have to pay salary for that fellow, I need money. So, what is happening? My current asset is not being financed by my current liability there, though it is there. Now, for paying salary for on 30th, I need money out there. I need money only for 3 days, because 3rd when he gets, I will pay that fellow's purchaser 7 lakhs, out of the 1 lakh I will return the loan and I will also have profit. Imagine I need to pay about 20,000 rupees. So, what do? I go out and borrow that 20,000 out there. So, the difference between these two, the asset and current liability, is what we normally call it as the working capital requirement in the process. Quick asset is fine, but inventory is not, but inventory is basically the major source of basically your current asset. That is where major source of payment basically happens, because for example, when I am making a sale on a credit, how do I give a credit to the fellow? Because somebody has given me a credit when I purchase the raw material, that is a major source, because somebody, that is a source of fund out there. I go back to source and utilization of fund. When I look at a source of fund, somebody, because creditor is also considered source of fund. Why? Because that fellow, instead of giving you cash, has given you raw materials, and because he has given you raw materials, your utilization, what have you done? You have sold it to somebody on credit out there in the process. So, this is when I say, sir, is entire source of fund should be taken in the liability side of the balance sheet? Well, we are looking at working capital. Working capital means day to day need. Day to day means need means what changes every day, what is the requirement. So, we look at only current asset and current liability. Can be cash? It does not, yeah, any form which can be converted to cash, any form which can be converted to cash. So, that is what we call it as the working capital requirement. That is the amount which you normally go and borrow from a bank. That could again be two different forms out there. Of course, bankers will have a norm for calculating all that current asset and all. Let us not get into the norm. There is Tandon committee, many committees, Chore committee, Tandon committee, etc. Let us not get into all the recommendations of it. Broadly, this is how it is done. Now, further, this working capital itself will be divided into two parts. One is a short term loan, and is a overdraft part of it, which I explained in the class out there when I sort of looked at the annual report. Overdraft is anytime you borrow, and sort of working capital, where a short term loan is you have a fixed term and then you basically look at out there.